Hello, this is Henry of AutoAnalysis, and welcome to the May 2013 European Car and Light Commercial Vehicle Production Outlook briefing. We'll start with a quick review of 2012. Production in Europe, including Russia, was just over 18.1 million. This was around a million down on 2011. Excluding Russia, Europe was down 1.3 million at 17.1 million. A complete collapse in production in Europe was prevented by modest growth in the Czech Republic, Hungary, Romania and the UK. Plus there was a major boost to production in Slovakia from the start of production of the VW Up. In 2012 the major losers were Italy, France, Spain and indeed Germany. The German fall was largely due to decline at Ford and Opel and model cycle effects at Mercedes and especially Audi and the switch to the new Golf. Let's now look at the production outlook best case highlights. First of all, Germany, well, we think it will recover to its 2007 level by 2017, but it won't quite get to the 2011 peak, which of course was influenced by scrappage incentives and boosted the market. The long-term losers, however, by 2017 will be France, who will be down around about 25%, or 740,000 on the 2007 levels. That's even allowing for Renault's renewed commitment to producing in France. Italy will be down around 20%, 250,000 or so, Spain around 16%, 430 to 440,000 or so, and that allows also for Fiat's reorganisation of production and Renault's proposed expansion in Spain. The eastward shift continues in production between 2012 and 2017. We'll see the Czech Republic up by nearly 10%, Hungary almost doubling, and Romania up by nearly a quarter. The UK is still growing, and if all goes well at Mini, JLR and Nissan, and they fulfil expectations, we expect UK production to reach over 2 million by 2017. This chart represents the situation in Europe, including Russia, by country through to 2017. And if you look at the total, it looks as though, including Russia, the market recovers well from 2014 onwards. But the reality without Russia is somewhat different. Here we see production in Europe, excluding Russia, not even reaching 21 million by 2017. And it really does take until that date before we get to the 2007 volumes. This is 1 year later than we projected earlier. The outlook for production, however, could be much worse, especially if the decline in European sales continues. This chart shows the base outlook, which has total production, including Russia, getting to 23 million. But the volumes without Russia are the much lower figures. The figures show that we don't get to 21 million until 2017 as before, but under the poorer scenarios we have much lower figures. And a fall in 2013 and the continued fall would mean that even in the best case scenario, which is the yellow line, 2016 would only be slightly better than 2008. And this raises the issue of Europe not actually recovering to the 2007 volumes for some time, if indeed it does at all. And if we have European production excluding Russia at below 17 or 17.5 million, or worse as in scenario 6, we don't think that the current industry structure will be sustainable in the long term. We have seen signs of structural change at the volume vehicle manufacturers in response to falling sales and production volumes. Last year, the EU 27 car markets fell to a 17-year low, and the figures for the first 4 months of the year show further decline. The volume vehicle manufacturers have seen significant production falls. Fiat, Ford, Opel, Vauxhall, Renault and PSA combined lost more than 3 million units in total production between 2007 and 2012. During the same period, total European production fell by just 2 million. The main winners, therefore, were at Dacia, Hyundai, Kia, Volkswagen, Audi, and the Japanese Nissan and Jaguar Land Rover. We're certainly beginning to see a new order for vehicle manufacturers in Europe beginning to emerge. We maintain our view that the volume brands are facing long-run structural decline as the value brands and premium marques continue to grow. And having lost over 500,000 units each in the past 6 years, we wonder whether the volume VMs will really be able to recover, or indeed if all of them can. So we now enter a period of restructuring and refocusing at the vehicle manufacturers. Faced with continued and rising losses, Ford, GM and PSA have announced plant closures. Fiat, by contrast, is reallocating production between its Italian factories, slimming down but not closing plants. It's going to bring back production from Mexico to Poland of the Fiat 500 when the model changes, and it's planned to use its European factories as global export bases for Fiat, Alfa and Jeep brands. That includes exports from Serbia and Turkey. Renault has reached a union agreement on cost-cutting in France, but this is in return for increased commitment to vehicle production in France, one of the highlights of which is adding Nissan car production to its European production portfolio. So we'll see around 80,000 Nissan Micros produced in France from 2016 onwards. As we've seen before, GM and PSA have established what we regard as a defensive alliance covering logistics, purchasing and some new models, although still the benefits are not fully apparent and we don't expect to see new models from this venture to appear before 2016-17. We think that further cuts will probably be required if demand and production falls again, and it remains probable that Fiat and Renault will need to cut further into their fixed cost base. The key issue then is, can export markets in Asia and elsewhere be Europe's saviour? The German and UK premium luxury brands have been recently very dependent on the US and Chinese demand for their recent growth. To date, these markets have largely held up, but we do ask whether non-EU export demand can sustain European production in perpetuity, especially at the volume brands. The Volkswagen Group, Fiat, PSA, and indeed Mercedes and BMW are all increasing production capacity outside Europe, especially in NAFTA, Brazil and China. Volkswagen's increasing production in Mexico, Audi's building a plant in Mexico, BMW's widening its US production portfolio and building a plant in Brazil. Some of these moves may actually harm struggling European production sites. For example, Renault Dacia production in Morocco could actually impact on their European factories' output, and labour problems in Romania could actually accelerate the switch to Moroccan production for Dacia. Thank you for listening. I hope you've enjoyed this production briefing video. Details of how to access the full report are now shown on your screen. Until next time, goodbye.